Hey everyone! Today we're diving into the exciting world of mergers and acquisitions, also known as M&A. This is where companies come together, either by merging into a single entity or by one company acquiring another. It's a dynamic and often complex process that can reshape entire industries. It's like a giant game of chess for businesses, and for savvy investors it's full of opportunities to make some serious money. Each move is strategic and the stakes are incredibly high. Just like in chess, the best players are always thinking several steps ahead. Imagine two companies joining forces or one company swallowing up another. This can lead to increased market share, reduced competition, and even new innovations. The possibilities are endless and the outcomes can be transformative. That's M&A in a nutshell. It's all about creating value and seizing opportunities. But it's not just about the big players. Even smaller companies can benefit from the right deal. These big moves can shake up entire industries and create tons of value for those who know how to play the game. The ripple effects can be felt far and wide, impacting employees, customers, and even the broader economy. Value investors in particular love M&A. They see it as a chance to find undervalued companies that have the potential to grow significantly after a merger or acquisition. They're like detectives, always on the lookout for hidden gems, companies that are worth more than their stock price suggests. They dig deep into financial statements, market trends, and industry news to uncover these opportunities. When M&A deals happen, these value investors are ready to pounce, using their knowledge to spot the real winners. They understand the intricacies of the deal and can predict which companies will come out on top. Think of it like this. When two companies merge, it's like combining their superpowers. They can leverage each other's strengths and resources to achieve things they couldn't do alone. Suddenly, they can do things they couldn't do alone. This synergy can lead to new products, expanded services, and greater efficiencies. Value investors are experts at spotting these superpower combos and cashing in on the action. They know that the right M&A deal can turn a struggling company into a market leader, and they're always ready to make their move. Now let's talk numbers. Every M&A deal involves a lot of financial jargon, but don't worry, we'll keep it simple. Value investors rely on a bunch of different metrics to figure out if a company is a good investment or not. One of the most important metrics is the price-to-earnings ratio, or PE ratio for short. It's like a measuring stick that tells you how much investors are willing to pay for every pound of profit a company makes. Another key metric is the enterprise value-to-sales ratio, or EV sales. This one compares a company's total value, including its debt, to its revenue. A low EV sales ratio could mean the company is undervalued, like finding a steal at a car boot sale. By mastering these financial tools, value investors can see through the smoke and mirrors of M&A deals and make smart decisions about where to put their money. Now, not all M&A deals are created equal. Each merger and acquisition has its own unique characteristics and strategic purposes. There are different types, each with its own goals and potential outcomes. Understanding these can help businesses make informed decisions. First up, we have horizontal mergers. These occur when companies in the same industry decide to join forces. Imagine two rival pizza places on the same street deciding to merge. By combining their resources, they can better compete with larger chains. That's a horizontal merger. Companies in the same industry joining forces. This can lead to cost savings and a stronger market presence. They do this to cut costs, eliminate competition, and grab a bigger slice of the market. It's a strategic move to consolidate their position. Next, we have vertical mergers. These involve companies at different stages of the supply chain. Picture a bakery merging with a flour mill. This allows the bakery to secure a steady supply of essential ingredients. That's a vertical merger, companies at different stages of the supply chain teaming up. This can lead to greater efficiency and control over production. They do this to gain more control over their products, from raw materials to the final goods. It helps in maintaining quality and reducing costs. Finally, we have diversification mergers. These are when companies in completely different industries decide to merge. Think of a tech company merging with a clothing retailer. This type of merger allows companies to explore new markets and diversify their offerings. That's a diversification merger. Companies in completely different industries joining forces. This strategy helps in spreading risk and tapping into new opportunities. They do this to reduce risk by spreading their bets and potentially tapping into new markets. Diversification can be a powerful tool for growth and stability. Section 4. Due diligence. Don't skip the homework. Before jumping into any M&A deal, smart investors always do their homework. This crucial step can make the difference between a successful investment and a financial disaster. This is called due diligence, and it's like giving a used car a thorough inspection before you buy it. Just as you wouldn't buy a car without checking its condition, you shouldn't invest in a company without understanding its true value. Financial due diligence is all about checking the company's books. This involves a deep dive into the financial health of the company, ensuring that all financial records are accurate and up to date. Investors pore over financial statements like balance sheets and income statements to make sure the numbers add up and the company is in good financial shape. They look for any red flags that might indicate financial instability or potential issues down the line. Operational due diligence is like looking under the hood of the car. It's about understanding how the company operates on a day-to-day basis. Investors examine the company's operations, like its production processes and customer relationships, to see how efficiently it runs. They assess whether the company can sustain its operations and grow in the future. Legal due diligence is like getting a mechanic to check for hidden problems. It's about uncovering any legal issues that could pose risks. Investors, with the help of lawyers, carefully review contracts and legal documents to uncover any potential risks or liabilities. This step ensures that there are no hidden surprises that could affect the investment. By doing their due diligence, investors can avoid costly mistakes and make sure they're getting a good deal. This thorough process helps them make informed decisions and increases the likelihood of a successful investment. Section 5. Activist investors, shaking things up for profit. In the world of M&A, activist investors are like the rebels with a cause. They buy a large chunk of a company's stock and then use their influence to push for changes they believe will increase the company's value. These activist investors aren't afraid to ruffle some feathers. They'll meet with the company's management, write letters to the board of directors, and even launch public campaigns to get their way. One of their most powerful tools is the proxy fight. It's like a battle for control of the company, where shareholders vote on who gets to make the big decisions. By shaking things up and demanding better performance, activist investors can unlock hidden value and make a tidy profit for themselves and other shareholders. Section 6. Symbolic value acquisition, finding hidden treasure. Now here's a strategy for the true bargain hunter's symbolic value acquisition. It's like finding a diamond in the rough, buying a company for a symbolic price, often just $1. Why would anyone sell a company for $1, you ask? Well, sometimes companies are struggling so much that their owners just want to get rid of them, even if it means selling for next to nothing. For savvy investors, this is a golden opportunity. They can swoop in, buy the company on the cheap, and then use their skills to turn it around. It's like buying a fixer-upper house and transforming it into a dream home. These investors aren't afraid of a challenge. They're looking for companies with hidden potential, like valuable assets or a loyal customer base, that they can leverage for future growth. Section 7. M&A for the savvy investor. Tips and tricks navigating the world of M&A can be tricky, but with a little know-how and preparation, you can increase your chances of success. First and foremost, make sure any M&A deal aligns perfectly with your investment goals. Don't put all your eggs in one basket. Diversify your portfolio by investing in companies across different industries. Next, pay close attention to the deal terms. Is the price fair and reasonable? Are the payment terms reasonable and clear? Don't be afraid to walk away if something doesn't feel right or seems off. And finally, don't be afraid to seek professional advice when needed. Talk to financial advisors, accountants, and lawyers who specialize in M&A. They can help you navigate the complexities of these deals and avoid mistakes.